So, hi everyone. This is Finance Meets Real Estate. We meet here every Tuesday, 6:30 p.m. Eastern time. We have amazing guests every week. So we've had over 100 guests at this point from the real estate industry, real estate syndicators, investors, multifamily, triple net investing, single family investing, and so forth. We've had a few lenders, such as last week, for example, and a few, various people in the real estate industry. So today we have Robert Pereira. It's a pleasure to have him on. So he's a real estate investor, syndicator. He's the managing partner of RC Multifamily Group. And so as he told me, they're just working on an $89 million deal, right, Robert? That's amazing.
That's correct.
Actually, capital raising it yourself, not institutional. So that's a pretty broad network, sounds like. So he is very qualified to talk about today's topic, which is investing in 100 units and above apartment communities. So he'll put his insight and background, share his insights and background into the field. So he has overseen acquisition and development for over 250 residential projects since 2008. And he has raised over 25 million. I'm sure all of these numbers are old. 25 million of private capital from his network, managed over 120 million of construction loans for these projects. So he earned an undergraduate degree in engineering from the University of Waterloo and an MBA in real estate and finance from the Paul Merage School of Business at the University of California, Irvine. So Robert and his family reside in Newport Beach. So, okay. So with that intro, I'm going to pass it on to you, Robert. And
sure.
If you have any questions, feel free to put them on the chat. We're going to do 30 minutes and then like Q&A.
So Stefan, first, I'd like to take the opportunity to say thank you for inviting me to your podcast. I've listened to past episodes, and it's very informative. I'm happy to be a guest today. So I've been in the multifamily space since 2019. The data in my bio, I've got to get it updated. We're probably, including the 25 million was what we raised in the single family space. Multifamily, we've raised a little bit under 60 million from our network. No institutional capital as yet. We have relationships that we are working through in the institutional side. We really haven't had a need as yet. Looking forward to expanding that. So we do have a need in 2023. We have bought and sold a little bit over 1,000 units in the last 3 years. Hope to buy probably another 1,000 to 1,500 over the next 12 to 18 months as we see good opportunities. The one that we are working on right now is a Class A apartment complex called the Blakely. It's in Pendergrass, Georgia, Atlanta suburb. What's really unique about it is it's new construction, but it's we've actually tied it up at 25% below market value. We're in at 212,000 a unit for 420 units, 89 million in purchase, buying it in phases. We closed on phase one last week. And so we're still attracting capital to that asset. Happy to share that opportunity with investors. We do have a few spots, a $33 million total raise, and we have about 6 million of equity opportunity left. But happy to answer any and all questions and look to share.
Mm-hmm. And so, I guess I'm going to start, or the others as well. I'm quite curious. So that's it's an $89 million assets, right? And you guys are raising it actually from your network. That's quite incredible. Do you want to share like some of your background? Like, how did you get to the stage of having a broad enough network that you can raise? Is it like what, $35 million or so?
About 33 million of total equity. Great question. So I've been doing this a long time. I'm 44. I've been doing real estate investing since 2008. So it's been 14 years. And so I've built a pretty big network along the way and been blessed to have had investors that started with me with maybe $100 or $200,000. And I have a handful of investors now that have several $1 million with me each. So that definitely helps to have that quality of investor in our network. We're very blessed. Along with my partner Sharon Srivatsa, he is a very well-known business coach and successful entrepreneur. So he's got a very, very large following of clients that he has helped along the way and that have become investors to ARC our company. So Sharon's network coupled with mine has made it very dynamic in that we're able to raise good amounts of money. At the same time, it's money that's been with us for a long time. So they, as they see, we're coming into, I think, a bit of a downturn in real estate. We see it as an opportunity because we think there'll be better and better buys to be had. I'm sure you're probably seeing something similar, Stefan, in your underwriting. Our investors are excited about that because they know us well, and so they're equity that will stick around during a downturn and allow us to buy wisely while others might be sitting on the sidelines.
Mm-hmm. So in terms of your the role that you play in your project, would you call yourself more like it's a person who focuses on the deal finding, the capital raising, or asset management? What is your kind of superpower or primary role that you like to play?
Good question. So we have broad scale ambitions. We'd love to, if you ask me where do we want to be in 3 years, we'd love to be at 5,000 units. And where do we want to be in 10 years? I'd love to be at 15,000. And so obviously that takes a lot of equity to be able to get there, but it also takes a great organization. So we've been building up that organization. I function as the managing partner and essentially the CEO, where Sharon is my partner as well as advisor to the overall company. We've got a chief operating officer, a director of acquisitions, a director of operations, and our team is actually based in the Southeast. I'm based in Newport Beach, California. That's where I've just always resided. But I'm in the Southeast at least once a quarter, and more often than not, more often than that as needed, alongside our on-site team that is Atlanta-based. So I manage all things in that I do help raise capital. I do look at deal flow on the underwriting side. I do look at operations alongside our chief operating officer. So I wear many hats, but we've got really accomplished people who work with me in each of those roles. Sharon works closely with me on the capital raise side. And then on the operations side, we've got our operations team that works with third-party management. And we're very thorough in the way we work with our third-party management. We want to make sure that we're protecting every investor's dollar by following up weekly on our business plans. And then on the acquisition side, we have our director of acquisitions who I work alongside as we look for more assets to add to our portfolio.
Mm-hmm. And so your markets, I know you mentioned the Southeast, but if you want to be kind of more specific on where
sure, you guys... Great question. So really our team is based in Atlanta proper. And so we look at a 4-hour radius of Atlanta as our core territory. So we'll look as north as Nashville, as east as west as Alabama, as east as the Carolinas, and as south as North Florida. So, the bulk of our buying has been Georgia-based. We have 1 asset right now in Alabama and 4 assets in Georgia. We're looking at another asset right now in Alabama. And I would say that the bulk of 2023 will probably be Alabama and Georgia.
Mm-hmm. So a question on the chat from Cedric. So he's asking, how did you cultivate those first investors that you got?
Investors.
Not necessarily in a way.
Yeah. So the first investors were just family and friends. I looked for good deals this was in the single family space, deals that I knew I could cash flow. I was buying to renovate and sell, but I knew that I needed a backup plan because it was 2008 and it was a very challenging time for real estate. Nothing like what we're seeing and we're going to see in the next couple of years is nothing like 2008. This is a great market by comparison. So when you're trying to buy and sell after doing, basically flipping, you need to really think about, having a good backup plan, because that was, investors that were naturally would say, hey, what happens if you don't sell this for a profit? We'd be able to tell them that, hey, we were looking to refinance it, pay them back their money, and then rent it out for good cash flow. So that's how I was able to attract our first investors. And then from there, it scaled. We continue to spread the word. I started an email list that now has 1,500 prospective investors on it, current and prospective investors, and that started with 5 or 10 people, and then expanded over time. So really, it was just an organic growth model. But the biggest thing is looking for good deals and bringing value to investors. If you're giving them good rates of return, and you can show them that you're trustworthy, it scales with time. It starts small, but it definitely scales.
Mm-hmm. But so you mentioned in 08 you were actually capital raising those deals. You weren't only doing your own capital, putting your own.
So in 08 we were buying $100,000 properties, putting $25,000-$30,000 into renovations and trying to sell them for high 100s. And so if we had, if I was just doing one house at a time, I had enough money for that. But we were trying to do typically 6 to 8 of those kind of projects at a time. I had a couple of partners, and so we raised capital to be able to do that because it was beyond our own personal capital at that time.
Mm-hmm. So with prices declining, you were still able to raise capital, and kind of the story being so you're able to refi. And
and we never had to refi. We ended up selling them all. I regret not having refied, because if I was buying houses that had previously sold for they previously sold for $300,000-$400,000 in the peak in 05, 06, 07. We were buying them out of foreclosure at $100,000, and so they were just they'd sold at fraudulent numbers as far as just where lending standards were at the time. That caused a lot of trouble, obviously, and we were buying them deep into the red, where the lender was losing money buying them as foreclosures. We sold them, we made profits, but those homes are now, many of those homes are well past the $400,000 that they were in the last peak, and so we just held on to them and refied. Just keeping them as rentals would have been a lot more profitable than what we did back then.
Yeah. So basically in 08, it was already kind of, you were able to pick up deals, and you weren't, a lot of the price decline had realized as far as from your perspective goes, sounds like. And you were able to pick up foreclosures in addition to that, which further helped. And so it was basically a good time to do it, sounds like.
100%. Yeah.
Sure.
So what I did was I added, so we started in single family, we started with small single family projects, built up into luxury single family. Prior to forming ARC in 2019, I was building along with my partners luxury projects in Orange County, California, where we were selling in the $3 to $6 million range. That was the sale price of the luxury homes we were building. And the reason we pivoted to multifamily was we had more investor capital than we could responsibly deploy in single family, and we thought we needed a business model that we thought was scalable and that was more systematic. Multifamily proved to be that case.
Mm-hmm. So another question I have, so now how do you, how many co-GPs you need to raise $33 million of equity for your current deal? What is?
Yeah, good question. So how many co-GPs?
Mm-hmm.
I don't have any other co-GPs. I'm the only, ARC is the only GP.
Your partner, basically, you guys raised
We raised it all. Yeah. I mean, we'll look at taking on co-GPs in the future. We just haven't had that need yet. I'm not against it. It's just that a co-GP that would be significant would need to bring in, they have $5 million they can raise, and they can raise it fairly quickly. Then we're definitely interested in talking. But if it's smaller amounts, then we can just do that organically. It's a lot faster to work internal to our network, or to seek pref equity or institutional partners that would make a little bit more sense given the speed at which we sometimes have to move. But as far as our average investor is a little bit under $400,000 is the average investment amount. So our investors are writing larger checks than some groups. So I would say we'll probably have on that 33 million, we'll end up having somewhere around 100 investors for the full amount.
I see. Got it. And then you mentioned it's no institutional. There are no family offices. It's purely individual investors.
Yes. Yeah. We've talked to several family offices. The reason that we didn't use any family offices for that particular deal is we'd already gotten commitments from so many of our friends and family and our network that once we were at it, we raised out of 33 million, we raised more than 20 from our network. And so therefore family offices less likely. Most family offices want to come in a majority LP position. So we had family offices that were willing to come in and write big checks, but we'd already committed to our own network. And so we stuck with that.
Mm-hmm. Okay, so a question we have actually on the chat from Quincy. So how do you scout those larger deals? Are they off market, or do you rely on brokers to provide your pipeline?
Great question. So we largely rely on brokers to help feed us opportunities. This particular deal that we're closing on, the Blakely, we did get it off market through our network. We had bought us an asset not too far from there. We tied up the Blakely in Q1, and we bought the asset that was 20 minutes away, which is a $25 million, 120 unit asset. We bought that asset in December. So because of being in that area, we were tuned on to opportunities. And so we're able to pick up the Blakely off market before it became marketed.
Mm-hmm. Okay, but all right. But other than that, it's just you're being the top choice for brokers in your markets. Sounds like, right?
Yeah, and it's it's really cyclical, right? There the way I see it, like you do a deal and then you kind of you're going back into raising mode, and you're like there's enough deals I think for everyone to be able to you never start at being the top dog in the market, right? For lack of a better word, if you look at a market like Atlanta, the people who are top who get the first call, they have like 10,000 plus units. We have 1,000 units. So while 1,000 might seem like a big number, it's not 10,000, right? So, and there's some people with 20 and 30,000 units. Though, it doesn't mean we're not going to get good deal flow. I think everybody kind of looks at deals differently. And so I think most deals are bought on market, and most deals are bought just by kind of putting enough offers out there. And then, eventually you'll get a look from a seller, and the opportunity comes from there.
Mm-hmm. So we've had actually Omar Han on this webinar like a couple of weeks ago. I think he targets Atlanta. So he was saying, okay, there's like 4 brokers there, right? It's like four brokerages rather, right? So there's like Vercadia and so on and so forth. Yeah. And so like, is your sense those few brokerages, conceivably they do have preferred people to contact, but would you say they kind of pitch a deal? Like, has been your market sense? There's like, do they pitch a deal?
I know Omar well. He's not wrong. There's definitely some powerful brokers: Cushman, Vercadia, Marks and Millichap, Brown, Greystone Brown, CBRE. So it's more than 4, but there's not like 100. Let's say there's like 10 that are powerful. And they definitely do have preferred buyers because they're looking for people who are going to transact quickly. But that doesn't mean that they won't have assets that don't fit. Like if you have a 65 unit asset, that's not necessarily going to target bigger companies. They might, that's going to target a smaller buyer. So there'll be opportunities there. And then it's just a matter of also waiting it out. And, eventually I think if you follow up with the brokers with good cadence, you become known to them. And so even though you may not be big in size, they know that your follow through is consistent and they want to give you a shot.
Mm-hmm. Okay, so another question from Cedric. So how often do you send out correspondence to investors and prospective investors? What type of communication do you send out?
Awesome. Well, I can tell you, if you want to get on my mailing list, it's pretty easy. My email is robert@arcmf.com. I only say that so that way you can plug it in whenever you have a chance. I send out a weekly email update on what we're doing as a company, what assets we're looking at, opportunities to learn as well sometimes. And so that's how I usually will target all of our investors. If there's something specific to, we send out quarterly updates to investors as well, but that's to the investors who are actually in a specific asset or group of assets.
Mhm. Okay, interesting. So in terms of, so we mentioned like how we find the use case, like hello, just like agents, very much like agent relationships, finding well, the markets you guys focus on. What are like other major challenges you face in your work? I mean, like in terms of, I guess, asset management or other aspects, like what have been some particularly challenging aspects for you personally?
I think that it's a never-ending cycle, right? When you identify an asset, you underwrite it, you do all your inspections, then you have to, once you've decided to tie it up, or rather you might tie it up first and then do your inspections. You're then looking to raise capital for it, make sure you can get a loan that fits, and then you buy the asset. You then have to run the asset, perform capex improvements, make sure that management is doing well, making sure that it's leasing up, push the NOI as much as you can, and then when it's ready, you've got to go sell. And that's just one asset. Obviously, every asset should get that same kind of attention, but I think it's cyclical in that you're going to constantly have to deal with little things that you want to deal with in real time. I think the key is cadence and making sure that you're following up, daily, weekly, monthly to put yourself in a position where things don't fester. Where an asset, like I'll look at assets that are really poorly run, and that didn't happen overnight. That happened over months, in some cases years. So if you take the other attitude where you try and fix problems in the here and now, I think nothing becomes overwhelming, and you just have better assets and better run assets. And no matter how great your organization is, I think we have a great organization at ARC. You're only as good as your assets. But asset management is extremely important. Property management is extremely important. And I take the attitude of tenants are extremely important. For me, it's, give the tenant a really good experience, treat them not only fairly, but treat them like, value them, value your property management team, value your on-site team, which, your property management team, value your corporate team members, and of course value your investors, and things go, you have a better than not chance of things going right.
Mm-hmm. So okay, so then so another question from Quincy. So you mentioned that your current deal is being acquired in phases. Was this challenging to negotiate? Can you shed some light on how you approached the seller and why you chose this model?
Yeah, so we actually got asked by the seller to take down this asset, in the form of phases, because it would allow them to use their equity from selling. Like, so they sold phase one. We gave them, when we bought it, they paid their proceeds, which is funding a good amount of their future construction. So it allowed them to actually take on less construction debt, which worked out well for them. So they actually approached us about the phase purchase, which worked out well for us as well. Raising capital.
Certainly call you there, or to clarify, phase in a sense, is it like few different buildings and sort of closing on each?
Yes. Okay. Yeah, great question. So if anyone wants to look it up, it's the Blakely, Blakely, and the URL is live, live at Blakely, Blakely.com. So you can check out the website. It's a very nice Class A product. So we're very fortunate to own it. The first phase was it's 420 units total, Stefan, of which we bought the first 40%, 168 units, plus the clubhouse, the main amenity package, which includes pool, gym, and whatnot. And so that was phase one. Phase 2, 3, and 4 are each 2 additional buildings for 10 total buildings, 42 units a building. And so that's how you come up with the 420 units total.
Mm-hmm. Got it. And so because like the other part of the question is, okay, it's how you approach the seller, like why you chose this model. So you're saying, so it's simply like was an easier execution, sounds like, or?
Yeah, it worked out well in that we, like I said, the seller wanted to sell in phases.
Yeah. Okay.
Rather than wait till the end. We got favorable pricing because of that. We were buying it at 212,000 per unit. Phase one appraised at 265 per unit. we see comparable values in the 270s. And so for investors coming into phases 2, 3, and 4, the beauty is they're walking into significant equity from day one.
Mm-hmm. Yeah, which is awesome. And what are the next steps for you? Like, you guys just keep doing more projects, bigger projects? I know you mentioned getting to like 5,000 units in 3 years.
Yes.
Right?
Yeah. So great question. So we're going to keep doing more of the same. Add strategic assets to our portfolio throughout 2023. We'll sell stuff as it makes sense to do so, or refinance. But I would say that so when I say 5,000 doors, we might be at 3,000 doors, having sold off 2,000, let's say. But our goal is to
Right.
buy, including what we've previously bought. We want to get to 5,000 units bought within probably the next 3 years.
Mm-hmm. And are you looking to perhaps like become a fund in the future, or have a sort of collect primarily institutional capital instead of retail, or that's
no, we definitely would like to go and look at institutional capital as it makes sense. I mean, institutional capital really only makes sense when you're at a certain scale, because it's a lot more expensive.
Mm-hmm.
So it's like, okay, if you can really be at 20, 30,000 units, then you're not going to easily get there by just asking family and friends, right? We've gotten to 60 million in capital raised with our network. And that's pretty remarkable in that, like, most people don't get that big just with their network. And we think we can probably get to a few hundred million with our network. We're very blessed that way. But as we scale and need even more than that, we definitely will look at institutional opportunities and also institutional quality assets that go along with it. Assets like the Blakely. If we bought, 2 or 3 or 4 of those, we definitely would use institutional capital for other ones, because it would be, buying it at one time would have probably required institutional capital too. Because we're buying in phases, we were able to raise the capital in phases to allow us to keep it as just our network.
Mm-hmm. And when you say your network, so is it kind of like the email list you refer to, like 1,500 investors accumulated? And
exactly.
So what makes what have you guys done better than other syndicators in that regard? You've sort of focused on the quality and like bigger checks that those investors can write. So that has been kind of like, what type of leads do you guys seek to get to that investor base?
Good question. So, I mean, we do have some good connections in the tech space, in the real estate space, through my network and Sharon's networks. But the bigger thing really is we've been doing it a long time, right? So I have investors, like I said, who started with small amounts of money, 100, 200,000, and now are at 10 times that or 20 times that, and they have comfort. So I think what happens more than anything is as you take a long-term approach to things and you scale, it's, the investor checks get larger as well. Right now, our minimum is $100,000, and candidly, like I said, most of our investors are over $250,000 in invested capital. So that if we were a newer syndicator, it's hard to attract people to write big checks, because they not only want to look at your track record, but they want, like in many cases, someone's not going to write you a big check unless they know you really well and have known that you've been doing real estate for a long time. We've been doing it for, in my case, 14 years and have got a very good track record in those 14 years.
Mm-hmm. Okay. So we have actually a question. So okay, are you guys being cautious in buying in the current economic climate? What precautions are you all taking into consideration now?
Great question. So yeah, we've been very cautious. The only asset that we actually bought or tied up, we've tied up 2 assets that we've closed on in 2022. The Blakely, of course, and then another one in Alabama, north of Birmingham. It's called Pavilion, and that was a $12 million asset. So having said that, we've passed on a lot of deals that, especially in the first half of the year, that definitely would have been the buyer of those deals was overpaying at the time based on today's interest rates. We kind of saw interest rates rising. We saw that as a likely event, and so we were just cautious. As we go into 2023, I think we'll get less cautious because I think we're going to see a lot more really solid deal flow. So, I have a Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. I have always taken that to heart. And so I see fear in the market right now. So I think there's an opportunity to strategically be quote unquote greedy in what we're looking for, because we should see good opportunities.
Mm-hmm. Were you fearful in 2021?
Yeah.
When others
absolutely.
Okay. So that's
I mean, we were just very cautious. We had way more money than we had way more money than we deployed, because the deals just didn't look like they had the upside that was obvious. We really don't look for the most complicated business models. We look for ones where there's good comparable rents, and we believe that we can execute on the value add. So it's a combination of being able to execute on the value add to create really nice product, and then also having demand and local income to be able to support that higher rent. So if we can't accomplish that if it looks like it's going to be tricky, we'd rather just stay on the sidelines and wait for better deals to come along. Right.
Understood. Any change in the underwriting itself? Like, I don't know.
Yeah, definitely. I mean, we were underwriting to our day one underwriting. 9 months ago, if it was north of a 4 cap going in, we were okay with that. And then obviously we're looking for good pro forma upside. We're still looking for a good pro forma upside. That hasn't changed. What has changed is if it's a value add and they just have very low income day one, we may not as easily be interested, because debt is so much more expensive that we don't want to buy an asset where we have to feed it for too long. We really don't want to feed it at all. We want it to be self-sustaining with current income, so we can then go in and then juice the returns by raising the income.
Okay, understood. And so, so another question. So at your current capacity, what would you say is a reasonable number of deals per unit to acquire yearly without overextending your resources, I guess, for deals or units?
Good question. So we have third-party property management that we utilize on our assets. So for our current internal team at ARC, I think we can easily our goal is to add 4 to 6 assets next year that are in the somewhere between $10 and $40 million in purchase price.
Mm-hmm. And so other question. So it's a GP. What is the reasonable expectation of a compensation as a percentage of the deal?
So we look at it. Do you mean like if we're looking at a deal, what are we looking at as GPs to be compensated? How?
Correct.
So we actually look at it a little bit differently. We look at when we look at a deal, we have a profit waterfall with investors where they get obviously a preferred return, and then there's hurdles after which we can make first a little bit of money and then more significant money as we do better on the IRR. But our goal is to try and hit a 2x return to investors over a 5-year hold time. So we model based off of that. If a deal fits that, then we should end up doing very well alongside the investor. We can hit a 2x return to the investor.
Mm-hmm. So so Cedric is saying, so it sounds like your business model is primarily A and B class. Is that correct?
It's primarily B and C plus. From B plus to C plus. The Blakely is an A asset. It's an outlier. We're probably not going to buy another one like the Blakely in the foreseeable future. We bought the Blakely. We were extremely happy to own it. We got in at a very attractive price, but it was a unique situation. We don't think that that's going to happen again. Or at least not going to happen anytime soon.
Mm-hmm. What kind of IRR are you guys targeting there? If it's
on the Blakely, the IRR asset level is in the low 20s. Mm-hmm. And so our investor return on a 5-year is going to be IRR of about 16 to 17.
Mm-hmm. Okay. Okay, so I know you have hard stop at 7:15, right, Robert? So
yes, I do.
I just want to So I want to kind of open the floor if you guys have any questions. Do you want to raise your hand or speak up? Okay. Okay. So let's continue, I guess, with the chat. Everybody's kind of being shy. So another question from Cedric. So I see people walking around. Oh no, never mind. That's it. Okay, sure.
Oh, the people in the background. The people in the
Tell us
background
about
are.
your team. Yeah, tell us about.
Yeah. So this is my workspace. So those aren't actually my team is actually in another part of the building, but I'm in a conference room. So there's just people walking around. And this is a co-working space. So there are people that work at other companies.
Yeah, and how long? It's since 2008, right? So it's pretty long time of doing real estate.
Yeah, I've been at it a long time. I'll be at it, hopefully longer than I've been at it. I really enjoy doing it. And like I said, we at ARC we serve three groups of people: our tenants, our team members, including our on-site management teams, making sure that they're empowered to succeed, and then our investors get taken care of if we take care of everyone else.
Mm-hmm. What did you do before starting with real estate in 2008? So it sounds like you finished your MBA in real estate and finance at the time, right?
Yeah, great question, Stefan. So I came to California. I'm originally from Canada, Toronto, Canada. Moved to California in 2002. I used to work for a company called Broadcom. I was an engineer there for several years. While at Broadcom, I went to business school and did an MBA at UC Irvine. And then in 2008, branched into real estate at that time.
Mm-hmm. Got it. What else? Like, are there, because I've gone over a few questions myself, like, is there something you want to kind of share with our audience that you feel like it's going to benefit them in terms of like advice or like something you have learned over the years?
Great question. So let me ask you, what is your typical audience member? Are they investors? Are they syndicators getting started? What's the flavor?
I think we have both. I think looking at the audience now, we have some syndicators, we have some passive investors, we have some active investors, so pretty much a mix.
Very cool. So I'll tell you first, for syndicators, I think getting involved by raising capital as well as underwriting deals, things where you're learning, that's invaluable, right? Work really hard at it. It's a brute force approach to things, and the person who works harder will do better. Right? That's inevitable in real estate. If you're going to hustle, you're going to outlast those who think of it like it's not a part-time job. It can be, but then you're going to get a part-time income, and then you might as well just not do it. Do something full-time and excel at it, right? So really push hard. For investors, my advice would be, be cautious and make sure that those who you're investing with have real skin in the game. Like I put a lot on a deal typically that we're buying, like the $33 million equity. I'll put more than 10% of my own family money into that. So I absolutely write checks into my deals and make sure I have solid skin in the game alongside my investors. Some syndicators don't, right? And so doesn't mean that they're not going to perform well, but I think that for me, I like to know that the syndicator gets paid last, and I also like to know that they have real skin in the game alongside me, so that if things go wrong, rightfully so, they should also feel the pain.
Mm-hmm. And would you consider? It sounds like you guys are always like the lead sponsor. You don't partner with others. So
we're open to it. If somebody brings me a good deal, I'd be absolutely open to it. Right. And we've got obviously the capital to be helpful in the Southeast. So someone brings me a good deal in Atlanta and they're like, hey, this is a $20 million deal and we need $7 million and we have $2 million of it. Can you give us the other $5 million? We'll take a close look at that and see if there's a partnership that can be had.
As long as it's in your target markets, basically, it sounds like, right? Yeah, sure.
And if like our mantra is, if someone's going to have a controlling interest in the deal, they need to bring the controlling capital. So what we won't do is partner with someone who doesn't have too much skin in the game, and then they want to operate the deal, but we're the ones bringing all the capital. That hasn't that's not something that we would contemplate. But as far as partnering, where someone wants to looking for a capital partner that's also well integrated, has a good team, and can help, based on track record and everything else, happy to take a look at partnering.
Okay, got it. So Oleg is asking, what would you recommend a person who is just starting on this on his raising journey? What worked or did not work for you?
I think that capital follows the deal. So part of it is whether it's your deal or you're raising for someone else, pick just a solid deal, and I think that makes for an easier story. If you're just trying to raise capital without having something, and you don't necessarily have to have the deal itself tied up, you can just show someone a template of what you're looking at. This is the kind of deal I'm looking at. Would you be interested in investing in a deal like this? And that's a way to attract the capital, or you're talking about a deal specifically. The mantra of, hey, come invest with me because we know each other, that just doesn't get very far, right? People want to know that their money is, they'll invest because they trust you, but they're going to invest because you have an idea that's going to make them money.
Okay. Okay. Any last questions, guys, before we wrap up? What is the best way? I know you mentioned, so we share your email. So let me just mention it once again. Actually, I mentioned, so it's like robert@arcmf.com. So
that's correct.
Right. So Robert at ARC or ARC multifamily, basically. RCM.
Yeah, and all they is just shoot me a quick email saying, hey, please add me to your mailing list. I'll happily add you, and we can get a dialogue going, and you can see what we have coming up and see if it's of interest to you.
Sounds good. So that's awesome. Thanks, Robert, for sharing your experience with us. So lots of great insights, great experience. Pleasure to have you on. With that,
thank you, Stefan. I really appreciate it. Your podcast, you're a great interviewer, and your podcast is great content. So thank you for the opportunity, and thank you to the attendees who showed up to listen to us today.
Thanks, Robert. Thanks, everyone. Have a good night.
Thanks, everyone.
Thank you.